Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of our fave guests on these markets is Shalett. She's a chief investment officer for Morgan Stanley Investment Management. You've heard of them. They're pretty good over there. I've competed against them my whole career. I had some wins. I had some losses over the years, but they're pretty good. Lisa, we got to start with gold. I don't know what's going on. Do you have any idea what's going on? I mean, who's buying this stuff?
So I don't know if we have an idea. We have a hypothesis, right? So, I know over the last couple of weeks, a lot of folks have talked about gold as maybe a hedge to some of the frothiness in the equity market, et cetera. But we've really, been on this extraordinary run for the past, quite frankly, 3 years since the bull market began in the fall of 2022, with gold massively outperforming stocks. Wow. And so one of the things that, we've begun to think about is not just dollar debasement, but whether or not folks are really worried about fiat currencies more broadly around the world. And as folks really, truly think about whether or not there is a credible, reliable future for stablecoins and for crypto, whether some of this ecosystem needs to collateralize itself with gold away from fiat currencies. And so one theory we have is that some of these players may be trying to build some reserves in the yellow metal.
Gold massively outperforming stocks. I wanted to go there because this is not the correlation that we're accustomed to. And as we talk about kind of the uniqueness of this moment, perhaps the weirdness of this moment, what does that tell you? How does that kind of shape the way that you're looking at these markets? Well,
it really requires some creativity because a lot, to your point, all of these correlations are breaking down. And so one of the hypotheses that we have is that, we've got this scenario where, yes, we haven't seen inflation in the real economy, but perhaps we're really starting to see inflation in financial assets. Just too much liquidity from everywhere around the world, sloshing around, looking for places to go. And in the everything rally, we're seeing, folks buy, everything from gold to stocks to bonds to currencies.
I like this quote in your notes, Lisa. Bull markets are meant to be ridden, not timed. That's very good. What we have heard, maybe over the last year or two, but really over the last 2, 3, 4 weeks, is just the concern about AI. And it's been such a big catalyst for the broader equity markets overall, not just the tech space. But now we're starting to see some of these circular deals where this company's investing in OpenAI, who's then investing back and buying stuff and doing all that kind of circular stuff. Kind of feels a little odd. Is it odd to you? Does it feel frothy to you? How do you think about that?
It does. And for us, whenever these trends are transparent and trackable, which they really were for the last 3 or 4 years, you could say, I see the order book, I see the cash flow, I understand how they're going to fund these CapEx plans. But literally in the last 8 to 10 weeks, the deal making, the pace of the deal making, and the interconnectedness of all of it is starting to suggest to us that we're getting to that part of the cycle where, the analysts start making up new terms, this RPO and revenue that's been accounted for, that's still to be accounted for. It, kind of harkens back to the eyeballs and some of the words we made up during the peak of the internet. And so what our hope is here is that as these deals are rolled out, that the companies are making the effort to really help us map what is real, what is on the come, and what is, potentially just a promise that could vaporize if the demand isn't there.
As we think about the potential for froth or bubbles, what's the time horizon that you're looking at? What's the time by which these companies have to kind of find the proof in the pudding here that what they're doing is actually leading to something that's beyond just significant CapEx over and over again?
Yeah. So what we've talked about is how critical 2026 is, and probably the second half of 2026. And the reason is because the gains that we can really, credibly get from multiple expansion feels like we're getting to that point of exhaustion, and earnings need to come through. The controversy is not, are there earnings for, the hyperscalers?
Right.
I think everyone believes that. The question is, are there productivity improvements from some of the folks who are implementing? And again, I think we're willing to hold our breath for another 6 to 9 months. But I think by next summer, people are going to start saying, hey, show me the money.
Yep. How about are there certain sectors that's screening well for you guys right now at Morgan Stanley Investment Management?
Yeah. I mean, obviously, I need to be careful about, not talking my book. But, our favorite sector for the last 18 months has been financials. Obviously, maybe a tough tape to report into this morning. But these numbers, I think, from the sector, look reasonably strong to us. They obviously will have the tailwind of likely a steeper yield curve next year, of some, deregulation, in addition to a decent deal backdrop. So I think that that's kind of an ideal environment for them. And financials should be a place where we start to see stories, at least, of Gen AI implementation driving margin expansion.
Lisa, a few minutes ago, you mentioned dollar strength or dollar weakness. I guess it's like glass half full or glass empty. But I'm curious how much that has been driving your thinking over the last few months. The weakened dollar that we've seen, and I look at the Bloomberg Dollar Spot Index up a little bit here today, seeing a little bit more strength today. But the story has been one of a weaker dollar. And how is that shaping your view of things?
It certainly, does play into it. I mean, we've had a view that inflation is going to be sticky. And what folks need to remember is, while, a weaker dollar can certainly be helpful for the earnings dynamics for large multinationals who trade around the world and their competitiveness, a weaker dollar actually inhibits our ability to effectively price imports. And when you multiply that by tariffs, it's actually an even bigger headwind. So, we do think that weaker dollar is relevant to the real economy and to some of the forecasts here.
Lisa, thank you so much for joining us. Really appreciate it. Lisa Shalett, she's a Chief Investment Officer for Morgan Stanley Investment Management.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's focus a little bit on the fixed income business, because, folks, you're getting nice returns in the fixed income market this year, led by corporate high yield. It's giving you a nice 6-7% total all-in return. Yields pulling back. I got the 10-year Treasury sitting right at 4% here today for the 10-year U.S. Treasury. Karen Manna does this stuff for a living. She's a vice president at Federated Hermes. Karen, where are you spending your time these days in the fixed income markets? Where do you see maybe some opportunities?
Good morning, and thank you, Paul. We see opportunities really toward the very front end of the curve. We think the exercise for investors right now is carefully considering their cash vis-a-vis their money market funds, their deposits, anything that is interest-bearing and related to the movement of the Federal Reserve directly. So we think, considering the front end of the yield curve, 1 to 5, that will have the most influence or feel the most influence from the Federal Reserve, and then staying up in quality in your investment set and remaining diversified.
Karen, you may have missed it, but yesterday Paul and I were scratching our heads. The bond market was closed, of course, and we wondered why, as the equities markets were open. But I'm wondering if you can help us with the interplay here between earnings season and the bond market that you know so well. What are you going to be watching for, and how much volatility you are expecting here in the next few days as we get these big results from the financials in particular?
Of course, you have to dig in for us bond people taking an extra holiday just here and there. Just take it a day off to sharpen the pencils and do the math. No, earnings season is going to be very, very important, particularly here as we really start off with the banking earnings and listen to what these companies are saying. So already today, you're hearing the sharp impact and shifts related to policy, a step back from EVs, learning about how deregulation or lack of regulation is going to impact the banks, how they're benefiting from what could be or should be a foe in private lending, but it's actually benefiting some of the larger banks here. Those are the trends that we will look for. In turn, the fixed income market can be very sensitive to issuance. Supply and demand set prices. So we'll see what these self-funding banks do this week. Do they need to issue more? Or do they anticipate that their capital reserve buffers will be lowered and they won't have to issue as much?
Karen, we considered a 2-year treasury here get close to 3.5%. That's not a bad way to make a living, or do you want to take some credit risk here in this market?
I like clipping coupons here. I think you can do well with very minor credit risk. What we're not recommending right now is stretching into high yield, particularly into the darker, deeper parts of the market, the triple Cs, the lower rated entities. There you really aren't being compensated for the risk. We like in corporate credit, nice triple B risk, but really moderating, knowing the credit stories. We have seen those headlines that have reverberated through our credit markets and even equities at moments about folks that maybe didn't just do the basic blocking and tackling of fixed income work. What were the deals structured like? Was it too much chasing a deal, getting, money to work at a higher yield than really thinking through the process, checking the collateralization and doing the basics of fixed income work. So stay toward the front end of the curve, up in quality. And that's what we're hearing from many of our institutional clients as well, is that emphasis for just having fixed income do its basic job. Be the ballast of the portfolio, clip the coupon, not be too far over your skis.
Karen, we look at the markets and see very little reaction manifest from this government shutdown. So maybe indirectly we're seeing more of a reaction that in terms of not having the data that we're accustomed to. And I'm curious how you're kind of finding your way through this world without it. We're going to get these CPI data, but delayed by more than a week. Brought folks back in to make sure that we get that on the 24th of October. How are you making your way through? How's that complicating matters for you as an investor? And how's it complicating matters for Federal Reserve policymakers who are getting ready to meet here at the end of the month?
Sure. Thank you, David. It is a very interesting time. We seem to shrug off these government closures and lack of data. And I think there's too much of an assumption, almost a complacency again, that the Federal Reserve's path is completely known rather than data dependent. And the fixed income market is being pushed around by other forces right now. We're being pushed by the policies, the administration, the talk between China and the US. And that's why you're seeing the 10-year yield here reflecting a safe haven type of a move, even the dollar bouncing a little bit stronger. So it's the concerns globally right now and with our policies with these other superpowers that I think is really weighing on the yield curve at the moment and allowing us to shrug off the lack of data. Of course, we'll look at private market sources to some extent, but the notion right now is that the labor market is firm, but beginning to show signs of weakness, and that the Federal Reserve will continue with 2 eases of 25 basis points each over the remaining 2 meetings this year, and the bond market is taking that as somewhat of a known.
All right, Karen, thank you so much for joining us. Always love chatting with you about the fixed income business. Karen Manna, she's a vice president at Federated Hermes.
Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I want to talk a little bit about alternatives. They're a bigger part of the investment landscape than I at least initially thought and held for a long time. And that's both on the retail and institutional level. Shana Sissel joins us here. She focuses a lot on alternatives. She's a founder and CEO of Banrion Capital Management. Shana, thanks so much for joining us here. Love to just get your thoughts about kind of where you see some opportunities in the world of alternative investments today. We've seen precious metals have amazing runs here. We've seen crypto with a lot of volatility moving higher. Where are you seeing opportunities?
Well, I don't know if I consider those the kind of alternatives that you should be paying attention to. Those alternatives, crypto, maybe not as much, but precious metals, things of real assets, that has been an asset class that's been around for a really long time. There have been ways people have found to put in their portfolios those allocations. Where the more interesting things are happening are on the evolution and the democratization of strategies that typically were only available to accredited investors and qualified purchasers, individuals who had net worths in excess of $1 million to $5 million. And so they're now being available in different types of structures that make them accessible to everybody. Things like interval funds, ETFs. It started with mutual funds in 2007 when the rules changed for the 1940 Act that made it possible to do hedging and hedge fund-like strategies in a pure liquid form. 2019, 2020, active ETFs became a thing. Then it became available there. Now we've seen this rise of interval funds, which are making illiquid assets available in a structure that is accessible to everybody. So now you can get private credit, private equity, real estate, actual physical real estate debt, venture capital. All of those things are now accessible to the broad pool of investors. And these things were not possible before. So now we have, I almost feel like a flattening of access, where it used to be the haves and have-nots. We don't have that as much. Now it becomes more of what about the quality of the product that's being put out there? Like what's driving the push in these markets? I would argue that there's a lot of good product going out there from smaller shops that are looking to be able to access a broader pool of investors. And then I would say there's also some product that's being put out there that maybe isn't as attractive to the institutional investor. And so it's kind of being pushed down market. And I would argue that's probably not the best product. So there's definitely some issues, but overall, the trend we're seeing is just accessibility to types of strategies that were typically not available to the average investor. The gatekeeping in that respect has gone away.
Are you on the sidelines? Maybe not on the sidelines, but are you cheering the democratization of investment in the way that you describe? In other words, is having all of these options available to retail investors a positive thing inherently, or is this something that gives you pause? Again, a kind of regular investor's ability now to invest in the kinds of bespoke or, dare I say, kind of boutique funds you're talking about?
Well, there's a couple of things. I have mixed feelings, right? So my entire company is focused on making alts accessible to mass affluent financial advisors and their clients. So most investors, and I'm certainly supportive of that. The reason I became so passionate about alts was because I got exposed to them during the financial crisis when I was working for a hedge fund. And I thought to myself, wow, there's some really interesting stuff here. I wish my dad could invest in something like this. It might have helped him kind of manage the risk in his portfolio during the financial crisis. So there's value. But the problem is, as I noted, there's not always the best product that's being pushed here. A lot of it is just well-packaged marketing. And I see that more and more, especially with some of the innovations coming out in crypto buffers and crypto hedge products and levered crypto products. Those things concern me. I think my biggest concern is the lack of education, the lack of proper classification, the push for these new and exciting things under the guise of, well, now you can finally access it, but not really having the understanding of some of the complexities of these products. And so there are a lot of places where even the average investor, even though it is accessible to them, there are gates that they are hurdles they have to jump in order to actually make the investment. I know most people, if you were to go into your Fidelity or Schwab account today, most people, not all people, but most people, if you have not made your risk tolerance uber aggressive and you try to trade an alternative ETF, you can't. You'll get blocked out of it. So there are some hurdles in that extent. I think the bigger problem is that there's the lack of education, because I actually believe that the broader investment professional universe, that pool, maybe isn't as knowledgeable about these products as they would like to be. And there's some fear associated with that. But rather than addressing it, having intellectual curiosity and having resources of which you can become educated, I think that's the missing link that concerns me, is just things being packaged and marketed really well, but not fully understanding the complexity or even the design elements, especially with interval funds of these products.
Shana, thanks so much for joining us. Always appreciate learning about your part of the business and getting a few minutes of your time. Shana Sissel, she's the founder and CEO of Banrion Capital Management.
Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
It is that time again. It is Lisa, Mateo. Newspapers. I'm a little nervous about this one, but let's start it off.
Let's do it. What's a day without Taylor Swift news, right? Okay, so let's start there. I know David loves it. Okay, yes. So the Wall Street Journal has this look into how she rewrote the business of record sales. And so her album, The Life of a Showgirl, right? It came out October 3rd. In 5 days, had more than 4 million in album sales. So the reason how she did it is she put out 38 different variations of the album. Yes. So
physical
you have
copies.
Yeah, like CDs, vinyls, you have the digital downloads, you have cassette versions, you have some that have like jewelry with it, or some only have like certain acoustic songs. So the fans go crazy and they have to get up each one. And that brings up their album sales even more. So I don't know how many versions in your
Radical
house.
To me, you can still get a cassette copy of these things, but we did the digital download. We didn't get. Like my daughter might not know about these other things yet, so I'm hoping that's the case. Hope she's not listening now.
Everything she touches. I mean, again, I was born during Beatlemania, so I don't have a firsthand appreciation of it. But this has just been the biggest thing, I think, in music since.
I mean, just crazy that we saw those Disney shares jump on the heels of that announcement yesterday for this documentary series with her. So there's little she does wrong.
But we still don't have a wedding date, do we?
No, wedding dates.
All right, we'll see how that plays out.
We'll have to wait, and that's going to spark it even more.
Yes.
Okay, and this is like a love album too, so that's like the kind of tie into all that. All right. Want to go to the Washington Post? We've been talking about federal agencies, right, dealing with government shutdowns, layoffs, but now the Post has a look into another strain. It's this wave of retirements. They're saying it's like this mass exodus. I'll give you the numbers. It includes 154,000 federal employees accepted buyout offers. They were largely moved from the payroll as of the end of the month. And some of those are among the nearly 105,000 employees who took regular retirement during the fiscal year that ended in September. And that's like an 18% increase. So more people retiring on top of this that they have to deal with. And the problem is that they don't have enough workers to staff to process all these retirements.
They actually don't have the workers to process the retirements.
Yeah.
Unbelievable.
Can you believe
Did they get doged out? I guess maybe the thing. I don't know. All I know is I'm never retiring. So.
Never. Okay.
It's going to be here forever.
I'm your witness.
I'm going to be a greeter. My last job was going to be a greeter at Walmart.
I can see
kidding.
There. Wait,
not kidding.
There he goes. Okay, this next one.
This one I'm not.
Now, this is the teen craze. Now, your daughter's almost a teen, David, so I don't know if you've heard of this craze. It's 6'7".
Oh, I've heard of it.
And what happens when you say 6'7", David?
They repeat it. And it's less my daughter, more my sons who are younger than she, but they go 6'7". I mean, it's like a weird... I'm doing the hand
thing. And they
thing.
juggle. Like their hands are
I don't
juggling
get
if
it,
you're
but
watching on YouTube.
I've been told the point is I'm not supposed to get it.
Yes, you're not, because you're not the cool one. Okay, the kids are the cool one.
Yes.
But here's the problem. So it sparked this social media thing right in the spring, but now the kids are back in school, so it's becoming this uproar in schools, especially for math teachers who have to say 6'7" all the time, and the kids just screaming, 6, 7, and
so
move
this
their
is a
hands back and
viral
forth.
thing just
It's a
out
meme.
there.
It's a
Viral
meme.
thing. Where it actually came from. Okay, so I'll trace you back to last year. There's
This is
a rapper
news you can use. I feel like every adult, every parent needs to
because
know
I
this.
was wondering too. I was like, where does this come from? There's a rapper called Skrilla. Okay, his song is called Doot Doot. Okay, I sound really uncool
Paul, very
right
familiar.
now.
Paul's familiar with this.
It includes a phrase. So he says 6, 7 in it because it's a reference to 67th Street in Philly, where, you know, a lot of his friends grew up. So that's kind of how it originated. It sparked into all these different ways. But how teachers are dealing with it, what they're trying to do is they're starting to say it and do it too.
Themselves.
So maybe the kids will be like, well, that's not fun anymore.
I see.
If the adults
teachers are doing
doing
it, it's not
it.
fun. I thought you were going to say they're having to like rewrite the math problems, so that would be the right answer. But.
But the teachers are like finding all these fun ways to do it. Like they're asking ChatGPT, like, give me an exam that has all answers of 6, 7 in it. You know, like they're trying to have fun with
Gluttons
it.
for punishment.
But
All right.
it's a tough crowd for them. They're having a rough time with it.
All right, there you go. That's what you wanted. The newspapers with Lisa Mateo.
That's the single best idea.
That
I feel
could be
like
the
that's
single best
it.
idea.
With Tom out, we can do that.
Exactly right. So these things come out of nowhere, but you know, how long do they last and all that kind of stuff, we'll have to see.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.